Hello and welcome to the Harwood Report for February 12th, 2018, presented by Trade Academy. I am your host and the founder of Trade Academy, Keith Harwood. Standard disclosures coming up here. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Do your own due diligence before executing any trade. It's been quite a week, really a week and a half, that's just had a major movement. I'm going to walk through everything that we've seen going on. The VIX is something I want to focus on this week because that's where we had a lot of market structure problems that drove some of the moves that we had last week. That's why I'm going to touch a bit more on VIX and some of the leveraged ETFs that are paired with it. TLT is big because TLT, I think, was part of it was one of the things that people said was the reason that this all got started. And so we want to see where that's going to be going. And then, of course, I'll touch on gold and oil, with gold actually being particularly interesting the other way now. So it had a good pullback in a lot of the miners and silver. Gold didn't pull back quite as much. I got to look at that a little bit from the other side now, given the movement that we're having in the market and this general lack of demand for the risk-off asset that is traditionally found in precious metals. Oil, again, always important, and I'll touch base on that as well. So, since we've got a lot to go, let's just go through to the very first most important thing. That's not the most important thing, but extreme fear level. We are at a 10 on fear and greed. And it's not driven by fundamentals. It's driven by market structure. This kind of level hasn't been seen since 2015. I mean, we don't see these levels often. It's not driven by anything fundamentally. Earnings have generally been pretty good. But there was this VIX blowout. And so we have the safe haven demand, and they're talking about it in terms of stock and bond returns. This is a BS chart to me. The average put and call ratio, that's important. People have been buying a lot of puts because of what's been going on. And then market momentum is now pulled back. Stock price strength is just garbage right now. VIX is massively high. Everything is telling you that the market and the world is in an economic problem. And that's just not the case if you actually look at the fundamentals of the world. That's not to say that the market wasn't overvalued, but the kind of reaction that we got, I think, is a bit extreme. And let me touch base on what I mean by that. When I look at the S&P here, from highs, we pulled back roughly 10% to get down towards 259, 258. That's the 10% pullback. That's a big pullback. Tested here near the 200-day moving average, now flirting around with the 100-day moving average. A close above the 100-day moving average, I think, starts putting some relief to the world. It's the higher high, higher low, and I really want to see us close above Friday's high. Last time we tried to do that, we closed below the high, closed near the lows of the session, tanked on Thursday. Friday had the big pull down to the 200-day moving average of the bounce back. So right now, it looks like we're trying to find a bottom, but in order to really confirm the bottom, I need to see a close here in that 265 range. Right now, we're at 264. If I go to IWM, I want to note that this pullback was similarly around 10%. In the Qs, the pullback was around 10%. So all of these indices pulled back by 10%. Traditionally, S&Ps are about, we'll call it, 2/3 of the volatility of the Qs and small caps. So why did S&P drop so much relative to these other indices? Well, the answer is XIV. This is an inverse VIX ETF. It's basically going to be worth zero. It's worth $5.50 right now, but it dropped from 130 to $8 overnight, $7.50 overnight. This ETF replicates the performance of the VIX, but an inverse VIX. So when the VIX is up 50%, that had to be down at least 50%. Basically, the math on it is a little bit funky because there are some futures positions and everything else on it. I'm not going to get into that. The whole key here is that a lot of people have been investing in XIV, picking up pennies, knowing that it traditionally just grinds higher, and then it had a collapse because of the way that the liquidation and the contract is structured. And it's going to be liquidated this week. So VIX exploded, touched 50. Now we're seeing something that I like to see here as well. There hasn't been much of a bid to the VIX today. So the market is firmer, the VIX is getting weaker and dropping. This liquidation of this contract is going through. Something else important on the VIX, Spec futures length is at an all-time high. I believe it was all-time high. Don't quote me on that, but it is very long. So the market is very long VIX futures because algorithms chase trends. They bought a lot of VIX futures. They may actually have to liquidate that position. Now, on the other side, if we start to see the market bounce back and volatility dropping. So you can see a very quick move if this were to close below the 10-day moving average, which is 24.40. That's not that far away. Thursday's low was 24.41. So basically getting below Thursday's low in the VIX cash, I think starts to get some potential for a liquidation event in the VIX. Pushing it lower, putting some nice profits to shorts in VXX or shorts in UVXY. Those are the leveraged long VIX ETFs. And you note that they tend to have a decay factor because of the rule. All right, so I talked about the market structure. Let me talk about the actual trades now. So when I go back to SPY, on a close above the 100-day moving average here, say around 265, I'm going to start looking for this week, push us back up towards 272.5. It's a pretty good run for a week. It's about 3%. That puts a lot of confidence back into the market. The options are relatively priced for decent-sized movement there, but where I don't see it as priced in is an IWM. So IWM could get a little bit of a short squeeze. It's still trading below the 100-day moving average, so there's a lot less interest in buying the small cap so far. But a lot of times after we get these big market liquidations, the money flow starts off by covering their short position. So the best quote-unquote short in all of the major indices between these three Qs, small caps and SPY, was actually in IWM prior to the break. So I think that you could see some rallying in IWM coming out of it as a result. One other thing I want to note here is the difference between the price of the Qs and IWM. So when I look at historically, the green line there is the Qs price minus price of IWM. It's traditionally somewhere around $5. It's rallied nicely here as we got into earnings season and as we started the new year. A lot of money flow going into tech. On the liquidation there, it started to come back out. But now it's bouncing back up again, and you can see the Qs are having a very good day relative to IWM. This spreads back up to 11.5. If it drops towards 5, it's going to happen off of IWM buying or Qs liquidation. So to get back to a normal level, I'd expect to see maybe over the next 2 to 3 weeks some more buying in IWM and maybe even some buying in the Qs, but just not quite as aggressive. So maybe the Qs don't go back up to the highs. Instead, the Qs settle in closer to, and let's get this pulled up. There we go. Closer to 160. So if that settles at 160, 162 maybe, and IWM gets that money flow, that puts IWM towards 155, 157. That's a lot of upside over 2 to 3 weeks IWM. And it makes me really not that inclined to go in and buy a ton of the NASDAQ stocks. So I don't want to buy NASDAQ if I think that that's already overvalued versus IWM and that the money flow should go to IWM instead. So for me, the play is not to do necessarily anything in the Qs. Let this rally play out and focus on IWM, where the volatility has already started to get hit here, 22%. I expect the volatility to drop back down towards 15.5 or 16 into a rally. And if I look through here into maybe some February 23rd, or actually I want 2 to 3 weeks, so I'm going to go out to March 2nd, and I'm going to look here at a call butterfly. And the reason I want to do a call butterfly is because I think vol is going to get hit into a rally. I talked about a move potentially to 155 or 157. So what I want to do here is look at a 150, 155, 160, 165. Come on, pull that up there. 165, call condor. This works really well on a move to 157.5, but if it comes up a little bit short, I don't mind. So the problem here is selling this 160, 165 isn't a very good level right now. So to start, I'll be looking at starting with the 150, 155 call spread, and then if we start getting a rally up towards 150, 155, then I'll be looking to add a short 160, 165 call spread against it to reduce my premium. I need to see that call spread, this part, the 160, 165, closer to 30 cents for me to justify selling that. I'm not going to sell it at 2 cents. If it gets up towards 30 cents though, I don't mind selling that against this call spread, and then that captures that volatility crush into a rally. So the 150, 155 call spread would be my starting point, around $1.23, call it. And then into a rally, I'm going to look to adjust by selling a higher out of the money call spread. And that lets me settle into that 155, 157 range, maybe even a little bit of an overshoot to 160, while still capturing a decent amount of profit there. So that's my first real trade of the day. And the reason I'm doing a call spread again is because I think volatility is going to get hit into a rally. The 155 calls are still an 18.5 vol. I think vol is going to come down 2-3 points more than that, and we're going to get a rally. So I want to have that long delta, long gamma, but driving into a short vega position. So this is the first one that I'll be looking at today. It's kind of a nice structure for me to start with. Again, I expect to see VIX continue to fall now that this liquidation event seems to be coming to its completion. And that's why I need to have some short vega into a rally. The thing that seemed to have gotten it all started was TLT. It was this break, the stuff basically on the move from 122 down towards 120, 19, 18, scared the market. This looks like it's getting ready for a dead cat bounce. I'm not calling TLT bullish because rate hikes are still going to be there. If the market stabilizes, these rate hikes will be there. There's probably not going to be the 4 in a year. Maybe there will be. Probably got to get to next non-farm payrolls to know for sure if the data still supports that. But if the market continues to liquidate, if equities continue to sell off, they're not going to raise rates 4 times. If markets rebound, maybe they can consider it. So right now, I think that we're still looking at TLT for a bounce back. And last week, I talked about a 122 calendar. I still like that kind of as a play, but volatility has come up in the bonds a little bit from where it was last week. So what I want to avoid is really chasing this vol. Last week it was closer to this level, and there was a nice term structure setup to it. The term structure setup isn't as great anymore, so I'm going to still hold my position, looking for that bounce, but I'm not looking to add to that right now because, frankly, I've kind of got a decent play on, and it's not as leveraged as it was last week. Oops, wrong one here. So going back here, the vol levels, as you can see, it's around 14. I think this vol is going to come back down towards 12 or 11 once we get through the next non-farm payrolls number. And get through some of this other stuff that's going on. All right, so let's focus now on the commodity side. Dollar yen has been very weak as a result of all of this liquidation. They tried to keep dollar yen firm, partially because of the way that the bonds were continuing to break. But at the end of the day now, it's weak. It's testing the lows here. This low in September is 107.33. If it breaks below there, that gets very bullish for gold. And we saw last week, obviously, that gold continued to break, and it's finally just getting a little bit of a bounce today. And silver had a massive break, all the way down to 15.26. So those 15.5 puts that I was looking at when we were back up here, that looked pretty good. And now we're looking at it the other way, because dollar yen hasn't gotten any bounce, and yet all of the gold, precious metals, silver, and gold miners have gotten hit. You see GDX really got a nice washout on Friday before bouncing back, and GDXJ. Same kind of idea. So for me, GDXJ is now testing this consolidation area. Could position itself for a move back up to 35.36 pretty quickly. GDX is not yet back to the consolidation area around 22.5 to 23 range, but it would need to get through there to start pressing towards 24.5. So GDXJ is looking a little better than GDX because we're already in that consolidation area. SLV, a little bit of room to go here. It needs to get to 1610 before we can start talking about that push for higher. Of course, GLD has been the best performer. It has never retested this lower consolidation area. The high is 129-ish. A move back above the 10-day moving average here at 126.10 is a really potentially powerful signal for gold to push back towards 130. So what I need to do now is find the best volatility level. So in GLD, vol is basically at the high of the last 6 months. GDX, vol is coming down now, it's down about 3%, but it's well above the high of the last 6 months. GDXJ had a really big spike, again above the high of the last 6 months, and SLV, waiting for this to load, there we go. It's basically sitting at the same high level as GLD. So my best leverage, if I'm looking for an outright type play, is actually in GLD. And I kind of want an outright play because if gold firms, that tends to happen with vol increasing. May not happen this time. This may be a case where everybody buys all assets, so we get buying of stock, bonds, and precious metals, creating some inflation, pushing volatility down. But I think GLD may have some of the best R&R from that. So, and I'm looking at stuff for just the next couple of weeks. And I can see here that March 2nd vol is the same as February 23rd, even though February 23rd has a holiday next Monday, and March 2nd has non-farm payrolls. So why wouldn't I want to own some March 2nd and be short some February 23rd? So I create a structure here again, looking for a potential for a breakout that would have to happen after non-farm payrolls. And you can see that volatility has come up quite a bit. So I don't want to be too aggressive just being long outright. This vol I set a while back. Now, when it was 10.25%, that was extremely cheap. 13.5 is still fairly cheap, but it could very easily get cheap, a little bit cheaper here, especially if equity vol comes down. So it's cheap relative to where equity vol is and where the VIX is, but that doesn't make it cheap overall. Now I go to February 23rd, and I just look to sell something slightly higher out of the money with a higher volatility level, 14.5%, and bam, I have a structure that costs about 45 cents into a rally. It could go to as much as, well, it could go over $1 because I'm longer the deferred option, the deferred contract here. But really, my optimal scenario here is a bit of a rally into the end of next week. These expire worthless, and now I'm left long a March 2nd 127.5 call that I can trade something around, whether it's turning it into a straddle, selling a March 2nd call against it to reduce my premium exposure, however I want to handle it. I can handle it better that way, knowing that I believe the February 23rd vol is overpriced relative to March 2nd. Note that the historical volatility in this product has been 10.5%, 11%, anywhere between 10 and 11 over the last 20 days. So why would I need to own 14.5 vol when the market is starting to calm down? Instead, I can create this structure that is very defined risk, and if volatility does come back down, I'm still okay because the March 2nd 127.5 calls should still be worth at least 40 cents. So I lose a little bit if gold just sits, but I make a lot if gold starts to grind higher. And as dollar yen continues to stay weak, I don't have a problem playing for a grind higher in gold. Finally, let's go to oil. So you can see that USO had a nice dip back during the liquidation event of the entire marketplace. Hasn't traded above yesterday's high yet. Still kind of in this little inside day, searching for a bottom, I guess we can call it. Well, I talked a couple weeks ago about how the euro has a pretty strong correlation to oil, and the euro is looking a little bit stronger, trading above yesterday's high, looking a little bit rounded, like maybe a bottom is forming here. If the euro continues to firm, then USO has some good upside. Thinking maybe back up towards this range, basically this little consolidation period from January, mid-January. So what would that do for XLE? Creates actually some pretty explosive upside for XLE. XLE got hit a little bit because of ExxonMobil earnings and Chevron earnings, but in general, looks a little bit better here after having a really big pullback. A lot of liquidation in XLE. OIH had a little bit less liquidation, but still looked terrible through this break. It finally caught up a little bit to XLE in the last few days. It's trading 29 2.5 weeks ago. XLE was trading 78 2.5 weeks ago. There's a lot of potential upside here if oil has found its footing and the euro continues to firm against the dollar and people start putting money back into inflation-based assets. There's got to be a trade there. In XLE, here's the problem. It's starting to come down, but this falls at 27% versus 18 before. I get it. The last 4 weeks have been pretty volatile, above 27%. Over the last couple months, it's closer to 20%. I think vol's got to come down here back towards 20%. I'm not sure if it's going to get back below 18 too quickly, but it's at least got to get back towards 20. OIH. Vol got bid all the way up into the 40s and is now starting to pull back. And I think this vol is probably going to come back down towards 30% from currently 38. So if oil firms, the euro firms, the market firms, I'm going to go to OIH because I like the leverage here and because I am a bigger long-term bull in OIH, as I've talked about before. And again, I'm going to look for a structure here in March to play for vol to come down towards 30% into a rally. So we'll make it simple. Just a simple call spread. I know the 12 cents doesn't sound like a lot, but if I do this call spread for 28, vol comes down into a rally, then I can look for something a little bit more leveraged if vol drops below 30. And if it doesn't drop below 30, this is still going to appreciate in value. At a price of $28 on expiration, it's worth $2. Currently, it's worth 28 cents. There is a lot of leverage there, but I get even more leverage if vol comes down into a rally. So that's how I'm looking at the OIH trade. That's it for the charts for today. So let's go through a reminder. This was the free stuff. I do a premium version as well. That newsletter will be out in a couple of hours, and I talk through more structured trades. I'm going to talk through some adjustment points, how I will look to manage some of these trades as levels get triggered. Right now, it's a big-time trading market, so there's a lot more adjustment levels that I have to have in mind. I'll talk through some of that in the Harwood Report, the newsletter, and midweek video update is $49 a month, but right now, if you sign up now, you get the first month for free, so it's worthwhile for the trial. I urge you to check it out, take a look, see what you think, and if you don't like it, it doesn't cost you anything. That's at tradeacademy.co/Harwood Report. And as always, you can email me, Keith, at tradeacademy.co, or call me 312-600-8004. Have a wonderful rest of your afternoon, and I'll talk to you all soon.